You work hard, you earn money, but before you even touch it, tax is already deducted. But a company can earn millions and still legally reduce how much tax it pays. Sounds unfair? It's not illegal, it's strategy. And once you understand this, you will never look at the taxes the same way again. Most people think that tax is fixed. It is not. Tax is not just about how much you earn, it's about how that income is structured. Employees have very limited control, but businesses, they operate under a completely different framework. Let me show you exactly how. The first and most powerful strategy is expenses. Companies don't pay tax on revenue, they pay tax on profit, and profit is simply income minus expenses. Now imagine this: two people earn the same amount. One is an employee, and the other runs a business. The employee pays tax on almost everything, but the business owner, they deduct office rent, internet, employee salaries, marketing costs, software subscriptions, even things like business travel. So, while both earn the same income, one ends up paying significantly less tax. Not because they cheated, but because they understood the rules. Now, let's take a real world example. A company buys a machine for $10,000. If they deducted the full amount in 1 year, their profit would drop sharply. But instead, they spread that cost over several years, let's say 5 years. So every year, they deduct a portion of that cost. This is called depreciation, and it does two things at the same time. It allows the business to invest and grow while also reducing taxable income every year. So, growth and tax efficiency happen together. Now, here is something most people completely overlook. Governments actually want businesses to succeed because businesses create jobs, increase production, and grow the economy. So instead of just taxing them, they also reward them through tax credits and incentives. For example, investing in certain industries, exporting goods, or even hiring employees can reduce tax directly, not income, the actual tax bill. This is where smart companies gain a massive advantage. Now, let's talk about something people usually see as negative: losses. If a business makes a loss this year, that loss does not disappear. It can be carried forward and used to reduce tax in future profitable years. So imagine this: a company struggles for 2 years, but in the third year, it becomes profitable. Because of the past losses, it pays less tax than expected. Even failure becomes financially useful. Now, here is where things get strategic and structuring. How you take money out of a business matters. Salary, dividends, bonuses, each one is taxed differently. Smart business owners don't just earn money, they plan how they receive it. In some cases, they even create multiple companies to separate income streams and optimize their tax position. This is not something beginners do. This is what professionals do. And finally, timing. Businesses have control over when income is recorded and when expenses are recognized, which means they can shift income to a later period or bring expenses forward legally. And when you combine all these strategies, expenses, depreciation, credits, losses, structuring, timing, you get one powerful outcome. They don't avoid tax, they simply control it. So, if you are serious about saving tax, you need to stop thinking like an employee and start thinking like a business. Because the system is not designed to punish you, it is designed to reward those who understand it. If you want practical tools, templates, and real strategies used by professionals, comment text below and I'll help you get started. Thanks for watching.